Hello and welcome to Between the T's, the knowledge sharing program from Texas Bank and Trust. I'm your host, Aaron May. So, is 2026 a good time to buy a home? How do we even know if we're ready to buy a home? And where do we even begin this process? For many of us, buying a home can be one of the biggest financial decisions we ever make in our lives. And it can certainly be one that feels overwhelming, especially when we're walking this process by ourselves. So today we're going to walk through this process together, and I'm excited for this conversation because I have on the show with me Deibert, president of the Van and Canton markets for Texas Bank and Trust. She is also a mortgage loan originator, as well as John Weakley, an assistant vice president and mortgage loan originator for Texas Bank and Trust, who also services the Canton and Van areas. Together, we're going to discuss some of the ways to prepare financially for purchasing a home, questions that we can ask our bank, and even evaluate some programs that banks offer that can assist with the costs of taking that first step into home ownership. But before we begin, remember that the information we discuss today is for educational purposes only. So be sure that you speak with a trained mortgage professional in your area about your specific needs. Also, all of the loan products offered by TBT are subject to credit approval. Now that we got that out of the way, welcome to the program, guys. How you doing today?
Doing good.
Good.
So we're going to just dive into the conversation today. We're going to talk about some of the loan programs that banks offer that customers may not even be aware of. And I can even talk specifically from my own experience. My wife and I, we bought a house probably about 10 years ago. And even though I work for a bank, there's things that I didn't expect. I didn't plan for when it came to the home buying process. We wanted to make a down payment on our house. We saved up money for that down payment, but there's a lot of things that were part of the process that we weren't prepared for. Do you guys know what I mean by that?
Mm-hmm.
So there's programs that had we known about them, we probably could have benefited from. So let's talk about some of those first, and then we're going to go into some of the specifics about what the home loan process is like. And where do I begin if I'm ready to buy a house? Am I starting with a realtor or am I starting with my bank? Let's actually start with that question. If I am getting ready to make a purchase on a home, or I feel like I want to buy a home, where do I begin? Do I begin with talking to a realtor or do I begin with talking to my bank?
I think I would go to the bank first to make sure and to pre-qualify, but also understand what amount you qualify for. Is your credit where it needs to be? Because I think a realtor would agree and push you back to the bank of, are you pre-qualified yet?
What does pre-qualification even mean? Because that's one of those things that it's an anomaly. John, whenever we sit down and we're getting ready to plan for a house, I just think I want to buy a house. What does it mean to be pre-qualified? Like Lace, you said the realtor may say, well, what's your pre-qualification letter say? I'm like, I didn't even know I needed a pre-qualification letter. So what exactly does that mean?
Yeah, and most realtors won't even show you a house anymore without having that letter in hand.
Really?
So basically what it is, we're taking your income, we're taking your credit, we're taking a look at all of it and putting it on paper and make sure that you're not going over the limits of debt to income ratios and things like that.
Yeah.
Because we don't want to put you in more house than what you can afford.
Right.
So that's basically the short of it is we're looking at credit, we're looking at your income. And a pre-qualification is pretty much just stated income. A lot of times we'll go a little bit further and go ahead and ask for paycheck stubs and stuff like that,
right,
just to build a stronger pre-qualification. So the borrowers are not surprised whenever they get a contract on the house and then we get their paycheck stubs and realize they didn't have their income correctly when they stated it to us.
Yeah.
Because that's always a devastating thing for a borrower to get excited about something. Then we have to dash their dreams by telling them that now they do not pre-qualify,
right,
or qualify because the information they gave us was incorrect. So,
have you guys ever experienced a situation where there's a difference between what someone qualifies for and what their budget actually says that they can afford? Because I know that was a big difference for me. When I looked on paper, the bank said that I qualified for this large amount, and we started thinking, wow, that's huge. But then when we started looking at actually what our paper budget showed that we could afford, there's things that the bank didn't consider. Like they didn't know about my Netflix account.
Yeah,
they didn't
utilities
know about
and things
my
like that.
utilities.
Yeah.
They didn't know about all of these things, and all of that stuff factors in when I start to look at, okay, 25% of my income says that I can qualify for that, but 25% of my life says I can't.
Right.
I think some of that is we look at the gross income too.
Yeah.
We're looking at a bigger number than really what you're taking home
Right.
each month.
So let's explain a little bit of the difference of that. So your gross income is what your paycheck says you make, but the net income is what you actually bring home,
Correct.
which can vary wildly. Yeah.
If someone is, making large contributions to their retirement, or
Right.
if they are covering their entire family
Yeah.
on health insurance. So it can make a huge difference versus what you actually make and what you are bringing home.
Absolutely. So when someone is getting ready to make that purchase and they come in and they get this pre-qualification letter, what all things are factored into that? I know you said it looks at your income. It looks at what other, does it look at your debt levels? Like what all does that factor into?
Yeah, so we're looking at debt to income ratio.
Okay.
And that can vary between institution. We're at 43% debt to income. So that's your outgoing minimum monthly payments versus your gross monthly income.
Right.
So we weigh that, and as long as it doesn't exceed the 43%, that portion would qualify.
Definitely.
And then looking at credit score, we have, for certain products, we have minimum credit scores, and baseline minimum is going to be a 620.
Right.
But that doesn't qualify you for every program out there.
Yeah.
So that's what we're looking at, primarily to see what best program would best fit the borrower, depending on their income ratios and their credit scores.
Definitely.
And Aaron, one thing that they miss too, I get this a lot of times with new borrowers, is they have to have a 2-year job history.
Interesting. Okay.
So they have to have worked at least in the same line of work. So
Gotcha.
they could be a teacher and switch jobs to a couple of different schools. As long as they're doing the same line of work, we can count the 2 years.
That's important. A lot of people don't think about that. I'm just new to an area. I just moved here, changed careers, brought my family in, and now I'm ready to buy a house. But according to these rules or these understandings, I probably would be more beneficial to rent for the first little while. Maybe buying a house isn't for me right now.
Right.
That doesn't necessarily mean it's not going to be for me in the future, but I need to have that history. But what if they say, well, like I've had a long history, but I just changed careers? Like that's something that you guys have to factor in.
We do, and we can take a look at it and see if there's somehow those two different careers correlate together. Is there a way to say, okay, that's really the same line of work that you're still doing?
Interesting.
If not, then we do have to wait the 2 years. The big thing we run into is usually going from W-2 to a self-employed borrower.
Right.
And that can cause huge issues of having to wait the full 2 years.
Interesting. So let's talk about some of the programs that banks offer to customers that they may not even be aware that they qualify for. I know a lot of people think that you have to have a large down payment or you have to have a lot of money set aside, but there's programs out there that customers can actually take advantage of that they may not be aware of. Have you guys had any experiences when you've had to walk a customer through a situation where they didn't even realize they qualified for something that benefited them?
Oh yeah, Aaron, we have a lot of customers that come in, they don't even know really where to begin.
Yeah.
And we do offer a couple of different 100% financing products that meet a lot more people than they realize.
Yeah.
We have a Texas licensed professional program. It's 100% financing, but it could be a school teacher. It could also be a nail tech or a hair stylist, all the way to a doctor or an attorney.
Yeah.
So it's a great product, but it covers a wide range of professions.
So there's a lot of things that borrowers may not even know to ask about. Like if someone's a doctor or for crying out loud, a massage therapist or something like that, they may not even think about well, this can help me qualify for a home loan.
Right.
I think something else neat about our first-time home buyer product is it doesn't necessarily have to be your first home. If you have not owned a home in 3 years,
right,
you would qualify for that program.
Interesting.
So that pretty neat, especially like you talked about. If you lived in an area, you changed careers, you sold that house, you moved, you lived somewhere else for 3 years, then you could qualify for a first-time home buyer product.
Absolutely.
Yeah, and we have had those scenarios. I've had them several times recently where somebody's just rented for the last 3 years, but they have purchased a home previously, and it's something that we can still qualify them for.
Very interesting. So I know that there's some myths that typically people run into whenever it comes to buying a home. And one of the first ones that I found was that a lot of people think that you need to have 20% down to buy a home. How true is that today, and what are some alternative situations where that doesn't technically apply? Why 20% down? Why is that the standard that people think?
The private mortgage insurance, if we are selling a loan on secondary market, they would require the 20% down to avoid private mortgage insurance. So that's additional PMI that's being added in your payment.
So what exactly is private mortgage insurance?
So that protects your lender. Because they are allowing a smaller down payment. It's a coverage to them for that risk. I think one big misconception, John and I have talked about this a lot, is FHA. It's 3.5% down. There are a lot of additional fees to the borrower, and that's where I think our first-time home buyer product really is a better option for most people, because we don't charge the PMI, whereas we are, asking for a higher credit score of 680 because of the risk that we're taking to do this 100% financing.
Right.
But I think it's a better product overall for a borrower and less cost to them.
Interesting.
Yeah, because in that case, like even the interest rate difference, a lot of times people get sold on the interest rate of FHA because it is typically lower than conventional. But when you factor in the mortgage insurance that they charge, plus the upfront mortgage funding fee, the payment could be higher with a lower interest rate than if you went conventional with a slightly higher interest rate. So that's always something that we try to make the borrowers aware, because if you go to a broker or even a real estate agent and that has a broker that they use, they're going to push FHA on you because they get paid more.
Yeah.
That's the good thing about us. We don't get paid any different whether we close your loan or not.
Right.
So, it's more incentive to be honest and be that trusted advisor that they're called to be here at Texas Bank and Trust.
Absolutely. We're going to take a quick break, and when we come back, we're going to dive into some of the steps that people can take to prepare for buying their first home. How do you prepare to qualify for that pre-qualification letter? And then whenever you go sit down with a realtor, what comes next? We'll be right back.
Hello, I'm Karen Partee with the TBT Financial Minute. From job loss to medical expenses, life is full of the unexpected. Be prepared with an emergency cash fund. Save up enough money to cover 3 to 6 months of household expenses and put it in an accessible savings or money market account. Should a crisis occur, you'll be prepared. Learn more at texasbankandtrust.com. TBT Financial Minute is brought to you by Texas Bank and Trust.
Member FDIC, Equal Housing Lender.
All right, we're back from commercial break with Lace Deibert and John Weakley. We are sitting here talking about the home loan process and how to prepare for that pre-qualification letter that John mentioned earlier. So there's things that people need to consider just in their own personal finances that will help prepare them for even finding out if they're even ready to buy a house. So what is the first step that a potential first-time home buyer should take when looking to improve their chances for qualifying for a house?
I think like what we had mentioned earlier, just taking the time to pre-qualify yourself, just looking over your own finances, because we're going to consider everything that's financed in your qualification. We do not consider utilities, cell phone bills, and things of that nature. Only the things that are financed that are reporting on your credit. Take those minimum monthly payments, take a look at those, and your gross monthly income, to weigh those against each other, and then kind of see where your comfort level is on your payment. That
So you
would
mean
be,
my $80 gym membership doesn't show up in my credit
does not
report?
show up. Yeah. So anything like that. So that's something to consider in your own personal, like, since we don't factor that in,
Right.
is that something that you can continue to pay for when getting a house?
Yeah.
You're what you think you can afford and what we say you can afford may be two different numbers.
Right.
Because we're not seeing the additional things that, your Netflix account, your Hulu, all that other stuff that you pay for that's not reporting on your credit.
Yeah.
So that would be the biggest advice is take all of those things and write them down and create yourself a budget and see what's comfortable for you.
We do have some great episodes on our channel about developing a blueprint for an effective budget. So you can always go back into our archive and find those episodes. And I think that's a very important first step in this process is identifying what you actually spend your money on.
Oh, absolutely.
And making sure that you have a plan for how that money is being used.
Because it's surprising how many people have no clue what they spend
Right.
and really don't care whenever they get, into the seat across from us. And then, we shock them with how much debt they actually have.
Wow.
And then, they're arguing with us that that's not right until we start reading off every creditor and they're like, nope, that's mine. Nope, that's mine.
Yeah.
It's people just get comfortable with taking credit card debt out or payday loans, which we highly, highly advise against getting payday loans because that's just a never-ending cycle of something you'll never pay off.
Right.
Well, you can, but you have to be disciplined to do so.
Right.
Once you get one, they'll hound you to get more. Once you pay them off. So it's just a never-ending loop.
Absolutely.
And I think equally as important is making sure if you do have that debt out there that you're paying it on time.
Yeah.
Paid, so it's not reporting late.
Right.
Because that can affect you if there's a lot of past due payments. We may deny you just based on that.
Wow.
Just showing that you don't have a good credit history of paying people on time.
Yeah.
Looking at your income, that's something to really gather your W-2s or your tax returns, and also what assets you have. And sometimes people they may not have, a ton of money to put down,
Right.
but they might have a great retirement built up that serves as an asset for them and shows all the reserves sitting
Okay.
there, if they did have to tap into a retirement
Right.
or something like that.
It's not necessarily something we recommend people do, but you have that there as a asset just in case.
Yes,
Definitely.
absolutely.
So what are some other factors that people need to consider? I know credit score is always talked about as a big part of the loan process. How much does credit score factor in versus I make, $75,000 a year or $100,000 a year, but how much does my credit score actually factor in versus my income?
So, like John had said earlier, we do require at least a 620 on our products as a minimum.
Yeah.
Some of the other ones are 680, which can give you a better credit or an interest rate on
Yeah.
those loans. The better your credit is, even if we were selling the loan on secondary market, the higher the credit score, it just shows a more stability of your borrower. It definitely helps them.
Okay. So what type of documents should a buyer have in place before starting to look for buying a house? I know we mentioned W-2s, my tax records and stuff like that, but what other things should I be considering to whenever I come and sit down at the table, you guys are going to ask me for all of this information. I don't want to be blindsided and feel like, well, I'm not prepared. What all should I have on hand?
So besides, having their tax documents, we also need their most recent 2 months pay stubs for them. The asset documents would be the last 2 months, checking, savings, retirement, anything like that they have available. If they've recently paid off something, the documentation to show that so we can exclude that debt that's on their credit. If they co-signed with someone, but it is coming out of an account from the other borrower and they're not on that account, they could provide a 12-month history.
Okay.
So we could exclude that debt. So there are additional options, and that might not be on a lot of borrowers, but that is something that sometimes people have done.
Absolutely. John, thinking about some of the, hidden conditions that may be coming with a loan that people may not be aware of. I know I don't believe Texas Bank and Trust has any sort of repayment penalties on loans, but is that something that people should be considering about? Like, well, what if I want to make extra payments? How do I allocate my extra payments to go towards the balance of my loan and not just towards something else?
Yeah, and of course, we don't have any prepayment penalties or anything like that. You can make extra principal payments on our loans. Now, we don't do the biweekly payments, but we don't have any policies or anything against making additional principal payments. Because some lenders can accept a biweekly payment, which basically equates to one additional payment per year. I believe that's how that math worked out. Or one principal reduction payment is how that would work out. So, but you can put as much towards the principal as you want to in an additional payment, but we just don't do the biweekly payments. But that is accepted at some institutions, and if you can pay more, then it's definitely encouraged.
What are some of the types of terms and conditions that people need to be aware of? Because I know not everybody who listens to our podcast is in a Texas Bank and Trust market. We would love to service them if they are, but if they're not, and they're listening to us, say from Arizona or from Nebraska or someplace like that, and they're looking to buy a house, what are the types of things that they should be talking to a bank in their area about, talking to a mortgage lender about, to make sure that they're understanding the terms of what they're getting themselves into?
I think just the importance of product knowledge, getting educated on the types of loan products that their institutions have, and not just going with what a broker says on FHA. Nothing against FHA, but there's more programs out there that's more beneficial. FHA is a great product, especially for the lower credit score individuals, is somebody that's closer to the 620, because they can offer the 3.5% down, whereas on the conventional, typically if you're less than 640 credit score, they may require the 20% down, because private mortgage insurance don't like to write their policies on somebody with a lower credit score, so it just may not be available. So 20% may be the only option. Just finding out what kind of options are out there, and down payment requirements, and there are certain cities that will have a down payment assistance in conjunction with a loan product. So and we offer grants, I think 4 times a year or something like that, for assistance on down payment and closing costs and things of that nature. So that's something that a borrower needs to probably ask about. And another thing too is, as far as closing costs go, you can always inquire that the seller, if the seller will pay concessions, like even our 100% products, the seller can contribute up to 3% of the sales price towards their closing costs. So where they would not have to come up with a down payment, but they'd have to come up with closing costs. But 3% should cover a majority, if not all, of their closing costs, if the seller is willing to do that.
That's another element that I wanted to ask about. What is considered closing costs? And when I bought my house, when we made our offer, they had me write a check that day for something called earnest money. Mm-hmm. How do those things factor into the loan buying process? What exactly is considered closing costs, and how is earnest money factor into this situation?
So the earnest money is basically just a kind of a good faith deposit that you're interested in buying the house. It's held at the title company. Of course, it will come out of their account, but it will get applied to the total closing cost at the closing table. So it is credited back to their closing cost. But yeah, earnest money is something that pretty much, if you're dealing with a realtor, if it's a listed house on the market, you're about 99% have to pay one of those. If you're dealing with just an individual, they may not require an earnest money deposit. But closing costs, it can be, an appraisal, which, typically we're going to ask for that money up front, but, prior to closing, because that is a third-party service. It's not a Texas Bank and Trust service that we offer. We have to reach outside of the bank to get that ordered. So third-party services have to be paid. Title's going to have their own fees for closing the loans and doing the title searches and research and things of that nature, and writing a title policy. And let's see, escrow is another one. The taxes and insurance, the collection for that. Most insurance companies are going to require at least 1 year policy paid up front or at the time of closing, and then we'll put 2 to 3 months in reserves for the escrow.
Yeah.
So that's one of those ones that a lot of the buyers are not aware of, that they'll have to pay that 1 year premium at the time of closing, and then we collect throughout the year, so we'll have enough money in the escrow to pay their taxes and insurance when they come due for the next year.
Definitely. All right. Well, we're going to take a commercial break, and when we come back, we're going to dive into some more of those unexpected costs that are associated with the home line process and some of the confusing language that's used even amongst bankers. Sometimes working in the industry, we can talk at such a high level on certain things that we don't realize our customers may have questions that we consider common sense. So we're going to dive into some of those areas and demystify some of those topics when we come back. So we'll be right back.
Hello, I'm Karen Partee with the TBT Financial Minute. If you've been a victim of fraud or suspect that your personal information has been compromised, contact your bank and credit card issuers immediately. File a police report, request a victim statement be placed in your credit reports, and keep a record of the authorities you have contacted. For additional information, call the Federal Trade Commission's ID Theft Consumer Response Center. TBT Financial Minute is brought to you by Texas Bank and Trust.
Member FDIC, Equal Housing Lender.
All right, we are back once again with Lace Deibert, president of Texas Bank and Trust, Canton and Van Markets and mortgage loan originator, and John Weakley, assistant vice president and mortgage loan originator, also with Texas Bank and Trust. As we left for commercial, we were talking about some of the terms that we use in our industry and the banking industry that can be unfamiliar to borrowers, such as private mortgage insurance, PMI, escrow, earnest money, and closing costs, and all of these other things that can actually be confusing for first-time home buyers or people who just haven't bought a house in a long time in the process of downsizing. Maybe their spouse bought the house a long time ago, and this is their first time dealing with the potential of downsizing after the death of a spouse. And they're trying to figure this out, but sometimes the language we use just goes right over their head. It can be confusing. It can be intimidating. John, have you ever experienced anything like this when working with a customer where just some of the things that we say may go over their head and we end up getting a deer in the headlights type look, trying to figure out what are we talking about?
Oh, for sure. Because like even whenever I'm talking, going through my information, I feel like I'm trying to convey all the information that I think that they need to know.
Yeah.
And I always have borrowers saying, "Is there anything else that you haven't told me that I need to know?" I'm like, "I don't know. I don't know what you don't know."
Right.
Because we do this every day.
Yeah.
Everything makes sense to us. We know the acronyms, and I try not to use acronyms because I'm aware that most people don't know what they mean. Like PMI, they don't know what it means private mortgage insurance, or HOI is homeowners insurance. We don't use those or try not to in our everyday interactions with our customers. But there's just certain things that we talk the lingo. We know it, like the back of our hands, and we don't know what the customer does or doesn't know.
Right.
And so sometimes I feel like I word vomit on them all the things that I do know, and I don't want to overwhelm them at the same time with a bunch of stuff.
But I love that, because that to me is what is really raw about this conversation. Because honestly, when I bought my house, we looked at how much we were paying in rent at our previous apartment. And then we looked at how much we could qualify for a loan, and we could buy a house for almost the same price that we were paying in rent. But then we realized that the money that was going into our mortgage payment wasn't all going to our house. Mm-hmm. In fact, a significantly smaller percentage of it was actually going towards the balance of our house. And it's because there are several factors that went into what made up that mortgage number. Lace, do you have any insight on what those four factors are and why they vary so wildly?
Yes. So most people on a typical first-time home buyer, they're going to do a 30-year mortgage.
Right.
And therefore, that interest is stretched out over that along with the principal. So they're making a principal and an interest payment. So the principal is actually reducing the loan amount.
Yeah.
And the interest is coming to the bank. That's what they're giving you on there. So a large portion of that, especially in those first few years, is going back to interest. You're not seeing a large reduction on your principal.
Right.
You also see taxes and insurance that are paid out as well.
Yeah. That's the part that got me, is like, because the bank would say, oh, okay, well, your mortgage payment is going to be, say, $800. But then whenever my statement comes in and it's $1,100, I'm like, why is my payment $1,100, but why is only $800 of it going towards my mortgage? And it's because, well, my property taxes was rolled into this. My homeowner's insurance was rolled into this. And even though my mortgage, if I got a fixed rate mortgage, stays at $800 for the entire 30 years, my payment varies because my homeowner's insurance changed or my taxes changed. And those are things that a lot of people don't even think about whenever they're buying a home. They think that, okay, if it's this much locked in, I have a fixed rate loan, it's that much for the entire 30 years. But, that's something that people don't really think about that can definitely throw someone's budget off over a long term.
Yeah, and homeowners insurance is one of those things you can shop every year.
Yeah.
And I suggest it because those companies won't be loyal to you even if you've been with them for 20 years.
Right.
I shop my rate every year to see if I'm getting the best rate because that does help, control your payment to a degree. Of course, with the homeowners insurance going up the way it has, you can only do so much, but there's always going to be a company out there that has a little bit lower rate than what you're paying.
So what do you look for when you're shopping homeowners insurance? What are you looking for?
I'm just basically I want to retain the same coverage that I have, and the bank's going to have a specific amount of deductible that you can have. So you don't want to have such a high deductible that it doesn't make sense for you to get it, and that's kind of what the bank looks at on a risk perspective. But if you can maintain 1% to 2% deductible, and then just have your premiums at a reasonable price, then that's what I'm looking for.
Absolutely.
At least a little bit cheaper than what I'm getting because homeowners insurance will go up just about every year. I've not had it where it hasn't gone up, from year to year. Right. So, and that's what I'm looking at is, am I getting the best deal? And that's the beauty of like an insurance broker. They can check all the companies they represent to see if they can get you a better deal with some other company. Just don't go within the same company that you have. Because whatever they're giving you is what they're going to give you.
Right.
And if you leave, it's no skin off their backs, what it feels like,
Yeah,
so,
absolutely.
It doesn't do us any harm by just shopping it.
Definitely.
Aaron, I recently just bought a new house and I did do just what John is talking about. My first quote was over $3,000.
Wow.
And the next one was $2,700, and the one I went with was $1,600. So
wow.
Huge savings.
Yeah.
And as coworker to coworker, we share a lot of when we're shopping rates like that.
Right.
For long, we're all shopping at the same place.
Yeah.
Yeah.
That's awesome. That's beautiful, guys. Thank you so much for sharing all of that. So what are some of the other things that you guys have seen that people may not be considering when buying a home that goes beyond just the closing table? It goes into the world of living in a home.
Yeah. I mean, utilities is something that you have to consider. Electric doesn't get any cheaper. It's kind of like homeowners insurance. And, going back to the homeowners insurance, again, that goes up every year. Taxes historically have been going up every year. You know? So those are things that you really need to consider and have a buffer for in your own budget for those things to increase. But yeah, no one can predict a water heater going out or AC going out, plumbing pipes bursting or whatever. Right. So, and it's hard to put a number on how much to have set aside, but if you can save for a down payment, then you can save for little emergency situations like that.
Definitely.
And in most, when you're buying a house, a lot of times they'll offer you a home warranty.
Yeah.
And so we highly recommend, you usually the seller is handling that first year of that cost, and
Yeah.
you can renew it in later years, but that could help offset any unknowns that might happen that first year.
Absolutely.
Yeah, because I can give a real life on that one.
Yeah.
I bought a house and I had a home warranty because it was an older home. It was built in 1969, and I don't know if the water heater was from then too or not,
Right.
but probably within the first 3 months of home ownership, the water heater gave out.
Wow.
And I paid $50 and got a brand new water heater, and they came out and installed it and all that other stuff. So, I mean,
Wow.
it was definitely worth getting that. Now, to have it ongoing may not, especially if it's over an older home, then,
Yeah.
if you're paying $1,000 for a home warranty and then your $8,000 AC goes out, then absolutely it's worth it.
Absolutely. Yeah, I know that we personally had that situation when we had one of our freezes a year or so ago, where all of a sudden we were noticing this wet spot on the floor that was new, and we finally looked underneath the sink and saw that there was a dripping pipe. And guess what? There's no landlord to call when you're a homeowner.
Mm-hmm.
You got to figure it out yourself. You either have to go hire a plumber, or the beauty of the internet is there's so much information out there that you can
YouTube it.
You can learn from YouTube University and get such an education that you can do most of this stuff yourself, which saves a lot of money on the long end. But it does take that extra step of being prepared and having a fund set aside. Jonathan, as you're saying, if you can save for a down payment, you should probably also be saving for an emergency fund, which also leads to an idea that, maybe when I'm trying to calculate what I can qualify for, I shouldn't necessarily only be throwing all of my savings at that down payment saying,
Right.
Man, I got $20,000 in the bank. That means I can put a $20,000 down payment. Well, I probably need to keep $7,000 or $8,000 on reserve. So I should only look at a $12,000 down payment instead of 20. And then I say, okay, now based on that, what can I actually fit into my budget? What is the things that in my life I actually spend money on? I need to make sure I'm saving for retirement. I need to make sure I'm saving for emergencies. I need to make sure I'm saving for my kids' college education. All of these things have to factor into that final price of when I say I'm putting this much towards the mortgage. That can be vastly different than what the bank actually says on paper you qualify for.
Oh, absolutely.
I don't think anybody wants to be house poor.
Yeah.
They can't keep living their life either just because they bought a home.
Absolutely. So thinking about that, like there's other things that people need to realistically consider when buying a house. What advice do you guys have for someone who is unsure of whether they're financially ready to buy? What should they be considering when they're looking at their budget?
I think, just I always tell people to pre-qualify yourself before you even come to come talk to us.
Yeah.
That's looking at your own income, looking at your own debts. What is it that you think you need to dump before you start trying to buy a house? What things you need to dump, like what things do you need to pay off?
Right.
And don't go paying off your biggest things. Just kind of get an idea, because it's beneficial to talk to your mortgage person before you start paying off debt, because you may be paying off things unnecessarily.
Yeah.
And using your reserves and your down payment funds to pay off things that you really didn't need to pay off in the first place.
Interesting.
So just look at your own finances. What are you comfortable with? Get that payment in mind. Because us as mortgage professionals has been doing it for more than 10 years, 13 years, whatever. Mine, I don't remember what my number is now, but, we can kind of get an idea of, if you say I can only spend $1,200 a month, then we're like, okay, that's like a $175,000 house these days with the interest rate.
Right.
So, we can kind of get an idea of where to even start with your pre-qualifications. Because people think $1,200 is going to afford them a $300,000-$400,000 house, and that's kind of a far stretch these days, you know. So we don't want them getting their hopes up of what they think that they can afford, and then we tell them that you're below $200,000 on what you can actually afford based on what we have. So just pre-qualifying yourself, figure out what your monthly expenses that you are comfortable with spending on a house in addition to what you already have. And
would you recommend someone taking what they think they would make as their mortgage payment and setting that aside maybe in a savings account each month to where it feels like you're practicing for that mortgage payment? Yeah, absolutely. If you can discipline that way, because a lot of times when people come to us, they're ready to
pull the trigger and, you know, haven't really thought it out and that discipline to prepare.
Yeah.
But that's, you know, that's something that would be great advice for a new homeowner or potential homeowner. Like if you can save up that amount of money per month, and you know that can go towards your down payment. Even on our 100% products, if you want to put a down payment, by all means, we encourage it, because you're still not getting charged private mortgage insurance on that. It's still a very, very competitive rate. You know, there's ways to finagle that, putting a down payment even on a 100% product.
Wow. Absolutely. Any last advice that you guys have that would be beneficial for someone who's just getting started?
I think too, they could always go on annualcreditreport.com.
Yeah.
Check out their credit and see what it looks like before coming in. A lot of people know, but some of our first-time homebuyers don't know what their credit looks like. If they don't have a credit card, a lot of credit card companies will give you a credit score, but it might not be anything like what we see when we actually pull credit. So, you know, while you're qualifying yourself, that might be another step to take too.
So what types of things, I know the credit score does play a factor, but it also, as you said, does vary. Where while the bank says, or the credit report company says I have a 740, but you know, then you look at, okay, what types of debt did you have?
Yes.
That stuff plays a massive role.
It does, and not everything reports to all three bureaus.
Yeah.
Sometimes we always take the middle credit score.
Okay.
For that reason, because you may have a few companies that are reporting to all, some that are only reporting to one, and there's three different bureaus out there. So we will take the middle one, so it's kind of your average usually.
Interesting. And that is all the time that we have for this edition of Between the T's. I would like to thank Lace Deibert, president of the Canton and Van markets for Texas Bank and Trust and mortgage loan originator, as well as John Weakley, assistant vice president and mortgage loan originator for Texas Bank and Trust, for being on the program with me today. Once again, remember that the information we discussed today is for educational purposes only. Please be sure to speak with a trained mortgage professional in your area about your specific needs. Between the T's is a production of TBT Studios and Texas Bank and Trust, member FDIC, equal housing lender. All TBT products are subject to credit approval. NMLS 402927. If you live within one of Texas Bank and Trust markets, we would love to be your bank. But if not, we hope that this information is useful for you no matter where you live. Until next time, remember that knowledge is power when it is shared between the T's. Thanks for joining us.